A trader is up nicely on a position and closes it almost the instant it turns solidly green, banking a small, tidy win. That same trader, on that same day, is down on a different position and instead of cutting it at the planned level, holds on, hoping it comes back, watching a small loss slowly turn into a large one. Same trader, same amount of discipline supposedly available, wildly different behavior within a few hours of each other. What's actually going on underneath that? Most people call this no discipline and leave it there. But that explanation doesn't really hold up because it's the same trader with the same discipline making both decisions on the same day. The real explanation splits into two separate, well-documented mechanisms. One about how your brain values gains and losses differently in the moment of the decision, and one about a completely separate resource that quietly runs out over the course of a trading day. Start with Daniel Kahneman, a psychologist who won the Nobel Prize in Economics for research into how people actually make decisions under uncertainty, much of it done together with Amos Tversky. Their central finding, prospect theory, showed that people don't evaluate gains and losses symmetrically, even when the dollar amounts involved are completely identical. Losses register as roughly twice as painful as an equivalent gain feels good, a property Kahneman called loss aversion. And it produces very specific, very predictable behavior once you know what to look for. Kahneman and Tversky's classic experiments asked people to choose between a certain smaller gain and a coin flip for a larger one, and separately between a certain smaller loss and a coin flip that either avoided it entirely or made it worse. People turned reliably risk-averse on the gain question, grabbing the certain smaller win rather than gambling for more. But the same people turned reliably risk-seeking on the loss question, gambling on a coin flip rather than accepting a certain smaller loss, even when the underlying math of the gamble was identical in both cases. The only thing that changed was which side of zero the number sat on. Now, put that directly next to the trader from the opening. The moment a position turns green, Kahneman's research predicts exactly the instinct to lock in the certain gain rather than risk giving any of it back, even when the setup itself hasn't changed and there's no real signal to exit yet. The same research predicts the instinct to avoid realizing that certain loss and instead gamble on a reversal, holding a losing trade well past the original stop level in the hope it comes back to even. This pattern even has a name in behavioral finance, the disposition effect, and it's been documented in real trading account data again and again. Traders sell winners too early and hold losers too long, not because of a personal lack of discipline, but because loss aversion is quietly running the decision underneath conscious awareness the entire time. Kahneman's work also found this effect gets stronger, not weaker, the more attention someone pays to short-term results. Traders who check their positions constantly, watching every tick move, experience far more of these small, individually painful loss moments, which, according to his research, produces more loss-averse, more erratic decisions than checking in less frequently would. Watching the market every second isn't the more disciplined approach it feels like in the moment. It's feeding loss aversion more raw material to react to all day long. There's a related finding of Kahneman's worth mentioning here too. His research on framing found that people make different decisions about the exact same outcome depending purely on how it's described to them. A strategy presented as having a 90% win rate gets treated very differently than the identical strategy presented as having a 10% chance of a loss on any given trade, even though the two statements describe precisely the same odds. Traders who only ever describe their own edge to themselves in win rate terms are quietly making their own losses feel rarer than the math actually supports, which is a large part of why a perfectly normal losing streak inside a genuinely profitable strategy can feel like proof that something has gone wrong. Is it strange that the more closely most people watch their trades, the worse the exact bias Kahneman documented actually gets? If this is changing how you think about why your winners get cut short and your losers get allowed to run, this is a good point to hit like and subscribe, because the next piece explains why that same trader's discipline can be completely fine in the morning and almost completely gone by the afternoon. That's where psychologist Roy Baumeister comes in. Baumeister's research examined self-control across a full day and found that willpower behaves less like a fixed personality trait and more like a muscle that fatigues with use, a state he and his collaborators called ego depletion. Every act of resisting an impulse, sticking to a rule under temptation, or making a difficult decision draws from the same limited pool. And once that pool is running low, the next act of self-control becomes measurably harder, regardless of how much someone genuinely wants to exercise it in that moment. In one of Baumeister's best-known experiments, participants who'd already had to resist eating fresh-baked cookies in favor of radishes gave up far sooner on an unsolvable puzzle afterward than participants who hadn't been asked to resist anything first. The puzzle itself had nothing to do with cookies. The willpower spent resisting temptation in one context simply wasn't available anymore for persistence in a completely unrelated one, because both were drawing from the exact same depleted resource underneath. Translate that directly onto a trading day. Every small decision, whether to take a marginal setup, whether to check a position one more time, whether to widen a stop just this once, draws from the exact same pool Baumeister measured in his lab. A trader who's already made dozens of these small, disciplined decisions since the opening bell has a genuinely smaller reserve left by the afternoon, which is exactly why the worst, most rule-breaking decisions of a trading day disproportionately cluster in the final hour. Not because the trader suddenly became a different person at 3 o'clock, but because Baumeister's depleted resource was running close to empty by then, on top of everything Kahneman's research already had working against them. Baumeister's later research also found something encouraging buried in the same data. The depletion isn't permanent, and it isn't purely willpower running out like fuel. Short, genuine breaks measurably restored performance on the self-control tasks that followed, and so did simple external reminders of a person's own values right before a difficult decision. Neither of those findings supports just push through it, which is the advice most trading forums default to. Both point in the other direction entirely, towards stepping away briefly and reconnecting with the plan you set that morning, rather than grinding out one more depleted decision on willpower that's already spent. Here's the counterintuitive part, and it connects both researchers together. The fix for beating the mental game isn't trying harder to resist loss aversion or willing yourself to have more discipline late in the day. Both of those approaches ask you to fight biology directly, in the exact moment biology is working against you the hardest. Based on Kahneman and Baumeister's findings, the actual fix is structural. Predefined rules that remove the in-the-moment decision entirely, set before loss aversion or depletion have any chance to distort it. Like a hard stop placed the instant a trade is entered, instead of a mental one revisited under pressure hours later. And a hard daily limit on the number of trades or hours screens stay open, set in the morning when willpower is still full, not negotiated in the afternoon when it's already running low. You can see both of these mechanisms clearly outside trading too. A shopper who returns a defective item without a second thought but keeps a disappointing purchase because it wasn't that expensive anyway is running Kahneman's loss aversion, refusing to lock in a small, certain loss even when it's clearly the better decision. Someone who eats carefully all day and then can't resist a late-night binge isn't weak-willed specifically at midnight, they're depleted, running on the same empty tank Baumeister measured back in his lab. Genuine research on parole decisions has found judges grant favorable rulings far more often first thing in the morning and right after a scheduled break, for exactly the same underlying reason running underneath a completely different profession. So what does actually beating the mental game look like for a trader, instead of just being a phrase people repeat without ever building it? It looks like placing a hard stop at entry instead of relying on a mental one you'll revisit later, because Kahneman's research says the in-the-moment version of that decision is already biased against you before you even open the chart. It looks like setting a maximum number of trades or a hard cutoff time before the session even starts, while willpower is fully reserved, not negotiating in the afternoon when it's already running low. And it looks like treating rest between sessions as protecting a genuinely finite resource, not as wasted time you could have spent watching one more chart, because a trader who never lets that reserve refill is fighting every single decision at a real disadvantage before the day has even started. Go back to that trader from the opening, cutting winners early and letting losers run. It was never really a discipline problem in the way it felt like at the time. Loss aversion was distorting the value of the exact same dollar amount depending on which side of zero it happened to sit on, and by the time the losing position actually needed a decision, the willpower required to make the hard one was already running low from everything that came before it. The fix was never trying harder in the moment itself. It was building the rule before the moment ever arrived, back when neither bias had a chance to touch it yet. Hit like and subscribe for more of this. If this changed how you think about the trades where your discipline seemed to just disappear, tell us in the comments whether it tends to happen more with your winners, your losers, or late in your session. Thanks for watching.